I'm Ty Carr, and this is my second video in a series on distribution planning for LLCs and partnerships. This particular video is distributions and economic effect. Why should you care about distribution planning? Well, maybe you're forming an LLC or a partnership and you want to think about your distribution plan as part of drafting your operating agreement and the formation steps at the beginning of this process. Or maybe you're in the process of revising your operating agreement for your LLC or partnership and would like to take a look at your distribution plan. Maybe your owners have negative capital accounts. That can always be tricky and warrants looking at your overall distribution scheme. And finally, I often find that owners or their either specific owners or as a group the owners are concerned about things like buying houses or medical expenses or other unforeseen needs that they may have for cash, and so they want to take a look at their distribution plan to see how easy it will be to get cash out of the LLC or the partnership if needed. So those are just a few of the reasons why this topic, distribution planning, may be more important than ever. And what we're going to be looking at today is specifically how your distribution plan relates to the concept of economic effect. Distribution planning should support the intended economic effect of your income allocations from prior periods. Economic effect is ultimately analyzed using what we call capital accounts. Capital accounts are the equity side of your business balance sheet. Capital account is what we call the owner's equity of a partnership or a limited liability company. The issue is that if your allocations lack economic effect, which you would figure out based on your capital account analysis after distributions, if those allocations lack economic effect, then you open the door to the IRS coming in and reallocating income the way they interpret your organization to operate. So they have the opportunity to use what they call the partner's interest in partnership standards to determine what they believe your real economic interest is in the partnership or in the LLC and reallocate items of income or loss the way they believe more reflects the economics of the business. And so I don't know about you, but I would rather plan for what I want the allocations to be and make them accordingly without being subject to the IRS changing them on me in the future. That's what's at stake, and that's what this topic is about. Understanding the concept of economic effect and planning your distributions to effectively coordinate with that. Now, one clarification as we move forward here is that in this topic we are talking about distributions. I have an article on LinkedIn and a previous video on YouTube where we talk about the different ways owners of an LLC could get paid by their LLC. And getting a distribution is not the only way you could get paid, but it is the context of this particular topic. So we're assuming that you've already made the determination or the decision that the payment that the owner will receive is considered to be a distribution, what we call the owner's distributive share. So with that, we're going to start with this first example, IT Consultants LLC. We'll be looking at, I'll bring up an Excel spreadsheet and we'll look at a scenario where we've got 4 owners, Ray, Jay, Kay, and Faye. This LLC will be taxed as a partnership and it will use a cash method of accounting for tax purposes. We're going to start at ground zero, so to speak, which means that there will be no assets in the business to begin with, there's no liabilities, and there's no equity. The partners have zero capital. No partners have capital to begin with at the beginning of the year in our example. We're going to show that the LLC earns $40,000 on a cash basis, which means that they've got $40,000 in the bank at the end of the year. And again, we will stick with zero liabilities throughout this example, so when they've got the $40,000 of assets, cash in the bank, that's going to result in them having $40,000 of owner's capital. All right, well, let's take a look at the Excel spreadsheet. Blow this up, and I'm going to refer to this to start out with as scenario 1. We're going to have 2 scenarios that we ultimately look at, and our partners were Ray, Jay, Kay, and Faye. I should say our owners of the LLC. and we'll look at the total. We're talking about partner's capital here, and we're saying that the beginning of the partner's capital is 0 for each of these, and that means that the total partner's capital is, of course, 0. There's nothing there. There's no assets, there's no equity. We're starting, like I said earlier, at ground zero. And then what we're saying is that they have cash basis income, and that income is $40,000. Now, the question that we haven't looked at yet is how should this income be allocated? And that's what I mean by scenario 1. We're going to look at a couple of options here in terms of allocation. Okay, so back over here to our slide deck. Let's look at our next facts. So in this example, let's assume that Faye receives a $25,000 distribution and the remaining owners receive $5,000 each. How does that distribution impact the economic effect of the LLC's prior income allocations? That is, when you see those distributions, what does that tell you about the economic effect of their prior income allocations? So let me model what we're saying here with the distributions and see how this looks. So bring my Excel spreadsheet back over here. And so what we're saying is that they distributed the total $40,000 of cash. So when we're all done, there's 0 cash, right? So we're saying those are the distributions. But factually what happened is that Faye took $25,000 of these distributions. And then the other members were saying took $5,000 each. Oops, let me make that a negative. I want my numbers to look similar there. There we go. Okay, so that's this is our distributions here, and I still haven't really answered the question of how income was allocated here, but this is how I'm modeling the distributions affecting their overall, what we call their capital accounts. Okay, so back over here, let's consider our first scenario, and that is what I meant earlier, or what I'm defining as scenario 1 is the following income allocation. That is that Faye is going to get 62.5% of the income allocated to her, and the remaining owners will get 12.5%. And as you'll see, what this means in the math of this, when you math all that out, is that we're allocating exactly the amount of income to Faye and the other owners to equal the distributions they received, right? So it's, you know, what came first, the chicken or the egg? Did they decide the distributions and then give each other the right income to support that, or did they give each other that income and then distribute the income to each other? You know, that depends on the way you operate your business, I suppose. But let's bring this over and see how it works out here. Okay, so what we're saying in scenario 1 is that Faye is allocated 62.5% and the other owners are allocated 12.5%, and we know that the way that math's going to work, so this is perhaps a little bit overdone in terms of using Excel, but I'm just going to go ahead and follow through here. So we're saying that Faye gets allocated, of the total income earned of $40,000, Faye gets allocated $25,000 to report on her tax return, and the other owners each get allocated $5,000. Now, the context of this, when I say they're allocated this income, the reason why the IRS gets into this issue is when we allocate this income to them, the LLC, when it's taxed as a partnership, is what we call a flow-through entity. So what that means is this income is going to flow through to their tax returns, and they're supposed to pay tax on these amounts individually. The LLC itself doesn't pay tax, and so this is what's at stake: is, are we reporting the right amount of income to each owner based on the facts and circumstances of all the other things that happen with this entity? That's kind of the key question here. And so what this scenario implies then, when you add all this up, is that each member ends with what we call a capital account of 0, right? And we'd say, okay, that makes sense, right? Because they started with 0, they earned $40,000 of income, they paid each other collectively the $40,000 back out as distribution, so they distributed all that income. We call that distributing their distributive share, and so now they all have no capital at the end, and that makes sense, and these income allocations are in perfect harmony with the way they made distributions, and so we'd say this entire scheme, this scenario 1, would be just fine, and we'd say it has economic effect. That is, there was no requirement that Faye and the others get an equal share of income. They got different shares of income under this scheme, but that's just fine because their distributions and their capital account analysis supports that as having economic effect. So let's see what would happen. What would be a scenario where it wouldn't obviously have economic effect, at least not obviously, unless you agree to some additional issues. So I'm going to copy some of this down here so that I can reuse it, and I'm going to call it scenario 2. And I'm going to get rid of these income allocations here just so we can redo it on a different basis, and you can see how my Excel spreadsheet is starting to do some extra math for me here. But here's the thing, we haven't allocated this $40,000 of income yet, so this isn't the final answer. This is just kind of a result of my spreadsheet. I'm going to leave that alone so that I can come back and determine what these allocations are based on what my case tells me happens for scenario 2. So let me move this out of our way and let's move on to talking about that. So scenario 2, Faye is allocated 25% of the income, and all the other members are each allocated 25%. So where are we going with this? What we're trying to say with scenario 2 is two things. We're saying that each member gets an equal share of income, but we're sticking to the fact that Faye gets a larger share of distributions. And the key question that we're going to be looking at with this is, can we do that? Is that fair? So let's bring this over and let's consider that, what we're saying there. So now in scenario 2, what we're claiming is each member gets a 25% allocation of income. When we do that, we say the $40,000 is divided evenly. Each member reports $10,000 of income on their personal tax returns and pays tax on it. Now it comes time for each member to take a cash withdrawal of their distributive share of income. But what's happening here is if Faye takes $25,000, she's actually pulling more than her share of income was for the year and more than any capital she had to begin with, so her capital account becomes negative. Her capital account becomes negative and the other partner's capital accounts become positive. And as we'll talk about, this scenario is problematic. This scenario can be problematic. So let's talk about what the problem is here. So what we have to consider is how would the owners be paid on liquidation? So in order to have economic effect, the concept is owners should be paid their positive capital accounts on liquidation. That is, for the prior income or loss allocations to be meaningful, whatever's left in the capital accounts is what owners should get. What's left in these capital accounts should determine what owners actually get. So when we take a look at this, therein lies the problem, because this analysis suggests that Ray, Jay, and Kay should each get $5,000 of cash. But there is no cash, right? When you look at this, there was nothing in the bank account to begin with. We had no assets, no equity on the balance sheet. We established cash on the balance sheet of $40,000, but we turned around and paid it out to everyone. So there's no cash. There's no cash at the end of the year, and there's no equity. The balance sheet is zero. The balance sheet shows zeros all the way across. But then if you dig into the partner's equity, total partner's capital is zero, but then you see it's really made up of this scheme here, where you're saying 3 partners are supposed to get $5,000 each on liquidation. How could they do that? The only way these 3 partners could get $5,000 cash on liquidation is if Faye were to put $15,000 cash back into the LLC. But will she do that? Well, she's probably not legally required to. Now, I say this with the caveat that I'm not a lawyer, but in most states, limited liability of the LLC means that they cannot compel Faye to put the money into the partnership. The legal position would be that Faye is not legally required to put this, I said into the partnership, but I meant into the LLC. She's not legally required to put this into the limited liability company unless she agrees to, because the default status of having limited liability is you don't have any liability to cover the debts of the organization, right? So what that tells us is if Faye does not have any kind of obligation to put this $15,000 in, then this capital account analysis doesn't make any sense, because these 3 cannot get their $5,000. And that's where the IRS may have a problem, because we'd say this situation lacks economic effect. It lacks economic effect because ultimately, based on the distributions that were made, this allocation scheme was not valid. This analysis leading to no economic effect causes us to look backwards and say, well, maybe income shouldn't have been allocated this way. Now, I can't pretend to put myself in the mind of the IRS, but what the IRS is supposed to do in this case is evaluate what they believe the partner's interest in the partnership really is based on all the facts and circumstances. And if I were the IRS making that interpretation, I probably would interpret it as being what we saw in case 1. That is, even if the partners had agreed and intended to allocate income equally, I might go back and say, well, really, this is what they really meant to do, or this is really reflective of their interest in the partnership, because Faye has no agreement to pay this back. She really should have been allocated $25,000 of income. The other owner should have been allocated less. And see what the problem with that is that if Faye reported her tax return this way, then she's underreported her tax, right? Because she's reported less income than she actually has once the IRS audits this situation. And on the flip side, the other owners actually have less income up here than they reported, so they maybe do a refund when it all pencils out. But that's messy. You don't want the IRS to go back and tell you that your allocation should be something different, and then have to amend your prior returns and have one partner be underreported and other partners be overreported. That's just a mess. And why would you want to do that, right? In other words, it's better to figure this out, make it make sense to begin with, so that you have a good leg to stand on in discussing these kinds of things with the IRS should it come up. Okay, so what could we do about this? Well, let's go back. Let's make sure I didn't miss anything looking at my PowerPoint here. So back looking at the PowerPoint, the point I was making a minute ago when looking at the Excel is our consequence of violating economic effect is that the allocations that were previously made could be reallocated. You know, if the IRS thinks like I do, then in terms of rationalizing through what the right allocations would have been, there could be a reallocation of prior income, or in this case, prior income would be what you'd be reallocating. So how can we solve this? In other words, is it possible? Let me look at the Excel again to frame this question, and that is, are we saying that if you allocate income evenly, you can never have uneven distributions? No. In other words, this scenario is possible. We can do this. We can end with three members having positive owners having positive capital account and one member having negative capital. This is a possible way for our capital accounts to end up, and we could still say we have economic effect. But to get there, in order for this to be an okay thing to do, Faye has to have an obligation to restore her negative capital in this particular circumstance. And so we refer to that obligation that I'm talking about, we refer to that as a deficit restoration obligation. So the way to solve the problem that we're looking at in this particular example would be for Faye to agree in the operating agreement, and usually it wouldn't be just Faye, it'd be all owners would agree together that they will restore their negative capital, which allows them to have negative capital and claim that allocations had economic effect. Now, if owners don't want to have an unlimited DRO, an unlimited deficit restoration obligation, they could instead have a limited deficit restoration obligation. So in the case of Faye, for example, she may project out that her capital account's probably going to run negative by $15,000, maybe as much as $20,000, and she could agree in the operating agreement that she would restore a negative capital account up to a total of $20,000, but no more. And that would give her enough cushion to have that negative capital that we see in this particular case. Now keep in mind, I'm not saying that all LLCs have to have a DRO, a deficit restoration obligation, in order to have economic effect. There are other situations where there are mitigating factors where you can get away without a DRO, where you can have other provisions in your agreement that would allow you to get away without having a DRO. But in this particular case, if we're going to make this distribution that exceeds her capital account, right? If we're going to agree to do this and we're going to plan to do this, we're going to know that it's happening and go ahead with it and allocate less than the distribution, I don't see how you would get away with doing this particular issue without having that DRO. So, to summarize what what we're learning in this particular topic and in this particular video, your distributions and the resulting capital accounts tell a story about the business that justifies or contradicts the economic effect of the allocations that you've been making up to that point. That's why considering economic effect with your distribution plan is important. What are we going to talk about next? Well, in my next video, we'll be talking about distribution issues for service businesses. We want to look at changes in who owns unrealized receivables. Well, thank you for watching this video. I'm Ty Carr. I provide advisory services to entrepreneurs and their accountants. I hope you join me for future videos and check out my articles on LinkedIn. Here are some of the resources that I'd love you to check out related to this topic. I've got an article on LinkedIn called What's Your Distribution Plan? Check that out. Subscribe to my YouTube channel below. Follow me on LinkedIn. Read more of my articles on my website, tycar.com, or just learn more about the advisory services I provide to LLCs and partnerships on that same website, tycar.com. Thank you, and I'll see you next time. Take care.